In this session, let's look at valuing equity securities using the market-based mechanism. So, when we talk about the market-based mechanism, we are bringing in the concept of multiples, price-based multiples, which generally come into the categories of tools like price to earnings ratio or price to book value. So, some kind of price based multiples. Today, these are the most powerful tools or most widely used tools as far as the valuation of the security is concerned. So, dealing with how, in what way we derive these price multiples and how do we use them as a part of the price determination process or valuation process of the security is what we are going to see in our in the current session. So, to start with, when we are talking about a multiple, as I have just now indicated, they are primarily in the form of ratios. The most commonly used one being a price to earnings kind of a multiple. Now, using that multiple, if I have to go for a valuation, I am using a mechanisms. How do I identify? Let's say for this company, for this particular security, what is the appropriate P by E multiple? For that, we are talking about two different mechanisms. How do I identify this P by E multiple of let's say 10 is suitable for company X? For that, the mechanisms that we are talking of is, one is a method of comparables. You identify, let's say I am talking about a stock X, try to identify all those companies which have a similar behavior as stock X, probably A, B, C companies, which have similar behavior, means probably from the same industry, same type of risk structure. So, you take those securities which have similar behavior of stock X or probably the index, the industry index. If X is a bank, then the banking index. If X is an automobile industry, then probably automobile index. Like that, the industry sector specific index. So any such scenario, you take all those companies and find out the multiple of each of those companies. Find out the multiples of each of those companies by understanding their specific prices and let's say their specific earnings. I'm just taking P by E as one such kind of a multiple. You find out for each of the company and probably use some kind of a calculation on the top of it, some kind of arithmetic on the top of it. Finally, to say for this company, this is the justified P by E ratio, justified multiple. You look at a series of companies which are comparable with this particular company, or you take an index which can be compared with this, which is more or less in line with this company, find out the multiple for that particular index or for particular series of companies, use some kind of a calculation and say that this is the benchmark value. This is the benchmark value for the multiple as far as this company is concerned. So, because we are using the comparable companies and deciding the multiple of those companies to be similar to this, because companies which are more or less in the similar industry, what we expect is their price to the earnings ratio should be more or less on the same lines, because when companies are performing more or less similarly, their pricing pattern should also be more or less on a similar lines. So with that kind of an assumption, we see that even though irrespective of the size of the company, the P by E or P by BV or any such kind of multiple should be more or less consistent within the industry. Under that kind of an assumption, we are going ahead choosing the similar comparable firms, finding out the number for those comparables and then using that number as the benchmark. That is what we call as a justified multiple using the method of comparables. The other thing is the method of forecasted fundamentals. Here I don't look at any other competitor or anything. Here using the Gordon growth or any other models, any other discounted cash flow based models, we have identified the formula for price. What should be the price, the value? D1 by R minus Z or FCFF1 by WAC minus Z. Some such kind of formulas, right? Using this, when I say P by E, I divide this by E, and finally probably this will give me the dividend payout ratio divided by R minus G. This is the way I define the multiple for firms when I am going with a forecasted fundamental. So forecasted payout ratio, what is the forecasted payout ratio for this company? What is the forecasted required rate of return on equity for this stock? What is the expected growth rate for this particular stock? Using these kind of forecasted numbers for the futures, we are going to find out the ratios for those kind of companies, the multiples for those kind of companies. That is what is the forecasted fundamentals based approach. That is what we take as the forecasted fundamentals kind of a approach, wherein you don't really compare any kind of comparable firms or nothing like that. You can directly use the projected fundamentals about this company and then get into the valuation process. So straightforward, the usage of the formulas. Once you know what is the value using an appropriate method divided by the earnings, which will give you the P by E ratio based on the fundamentals. Now here, earnings. If I am taking for the past 1 year, last 1 year, we call it as trailing P by E ratio. But if I am taking the earnings per share for the forecasted, expected for next year, we call it as leading P by E ratio. We just need to understand the difference between the leading and the trailing P by E ratios. Trailing is based on the earnings of the past year, whereas leading is the earnings based on the earnings of the current year. But whatever is it, the multiple is playing a key role in terms of the valuation process. Now, in this multiples again, if I am using the comparables, see, first thing I need to know is what is justified multiple. Depending on the method that I am using, if I am using method of comparables, probably some comparable stocks, some kind of arithmetic on those comparable stocks can decide what is my benchmark multiple or justified multiple. But when I am going with the forecasted fundamentals approach, whatever the P by E that is coming through this formula based mechanism, that is what we are calling as a justified multiple. Now what we say is we look at the actual multiple. Right now we start looking at actual multiple and compare it with the justified multiple. Justified could be either based on the comparables approach, or it could be based on the fundamentals based valuation approach. Whatever it is, you find out the justified multiple, compare it. If the actual is lesser than the justified, we say that that particular stock is undervalued, otherwise we go with that particular stock being overvalued. And if the justified is same as the actual, then probably we can say that it is equally a fair valued kind of a security. Now, how do I get into the justified values using the fundamentals itself? Okay, let's look at the most common. I'll come back to this otherwise. The most common multiples that we are typically talking of is the P by E ratio, which is price to the earnings. And if I am talking about the earnings of the last 4 quarters or last 1 year, we call it as a trailing P by E. If I am taking the earnings per share for the next 4 quarters, we call it as leading P by E ratio. Otherwise, price to sales, very common. The price per share divided by the sales per share. Price to book value, same thing, price per share divided by the book value per share. Then we have price to cash flow, the same way. In all these kind of cases, if the ratio is much higher compared to the competitors or compared to the justified, what is required. So if at all we see that the actual is much higher compared to the justified, we say that that particular stock is overvalued. Otherwise we say that it is undervalued. And one more thing nowadays that we are looking at under this price multiples kind of an approach is the expected dividend yield. Whatever is the dividend that is going to be expected in the next 1 year divided by the market price. So dividend yield is nothing but whatever is the dividend that is expected to be declared divided by the price. Means what is the return that the investor is physically going to get in the next 1 year going as a part of the dividend yield. So all these values we can get them directly from the market, because price is something that, if I want the actual values, the price can be obtained directly from the market, whereas all these things, the sales, the book values, all these things will come from the corresponding financial statements. So obtaining these ratios which get updated on a day-to-day basis is a quite comfortable kind of a task itself. But how do I find out the justified values for these things? Especially using the fundamentals. See, justified values using the comparables is quite easy, because I just need to select a few competing companies for this, do some kind of arithmetic on those numbers, and I can arrive at a justified value of those multiples. But when I am looking at fundamentals based justified value, these are the formulas that we are talking of. How am I arriving at these formulas? Let's look at it. If I want P by E ratio, right? We know that P is, going with the dividend discounting model, P is nothing but D1 by R minus Z. Now, when I want leading P by E, I am dividing it by E1. So what is happening? D1 by E1 is nothing but payout ratio, expected payout ratio divided by R minus Z. This is what is the leading P by E ratio from the fundamentals. So I will forecast what is going to be the future payout. I will forecast what is going to be the future required rate of return and the required growth and the expected growth rate, based on which I will decide that this is going to be the justified P by E multiple for this security. The other way of looking at it, if I want trailing P by E, same. P is still the same, D1 by R minus Z, but instead of dividing by E1, I am dividing by E0, which is the historical or last earnings per share. So D1 I will write it as D0 into 1 plus Z, divided by E naught into R minus G, which is giving me D naught by E naught is the current payout ratio. So I'll say payout into 1 plus G by R minus G. That is what will be the formula for the trailing P by E ratio. So I can very well think of based on the payout ratio, I can very well look out for payout. Based on the payout and the required rate of return and the growth rate, I can very well look out for what would be the trailing P by E or P by leading P by E or trailing P by E in this case. Now the same approach if I have to go for price to book value. Okay, price I still go by D1 by R minus G by book value. The easier way of dealing with all these things is the price, I will still write it as price by earnings into earning by book value. Easier to work out. Everything right in the form of price to earnings divided by earnings to book value. So here the price to earnings. So here the price to earnings, let's say if I am looking at payout divided by R minus G. Now, how do I express this earnings to book value? Earnings to book value is nothing but the ROE, how much I have earned, divided by the book value. Earnings by book value of equity is nothing but, the earnings is nothing but net income. Net income by equity is nothing but return on equity. So payout into return on equity, but this is historical. If I say this is historical, this formula will become payout into 1 plus G, trailing part. We are payout into 1 plus G by R minus G, right? So now we can very well write it as in payout. I can very well write it or probably even if I keep it like this, payout into ROE by R minus G. Now how do I write the payout? Payout is 1 minus retention ratio. 1 minus retention ratio into ROE by R minus G. So just expand it, ROE minus ROE times retention ratio. What is that? That is what is your sustainable growth rate G. ROE minus G by R minus G. That is what is the typical justified price to book value multiple. So when I say payout by R minus G into ROE, ROE is nothing but the earnings divided by the book value working out as ROE, and payout I will write it as 1 minus the retention ratio into ROE by R minus G, which will give me ROE minus G by R minus G kind of a formula for price to book value, the justified multiple. So all I need for that is the return on equity, the growth rate. So if I know the forecasted predicted return on equity, the predicted growth rate and the predicted required rate of return, I can very well work out on what should be the target P by BV multiple for this company, and once I know the BV for it at a future point in time, I can find out what should be the target price for it. So I'm not Just by knowing these three elements for the future, I am going to predict what should be the price of this particular security using the price to book value method. Same way, if I want the price to sales, okay, let me do the same. Price to sales. Simple way, I will write it as price to equity into equity by sales. Price to earnings into earnings by sales. Okay, so I can very well write this is earnings by sales, and this part I can very well write it as payout into 1 plus G by R minus G. Payout into 1 plus G by R minus G into E naught by S naught. So here at least I require few more variables. I require what is the payout ratio, I require the earnings, I require the sales, I require the required rate of return and the growth rate. Once I have all these things, I can very well go ahead with respect to arriving at a justified P by S kind of a multiple. Now, instead of payout, probably I can write it as 1 minus retention ratio. Retention ratio is generally written as B. So 1 minus the retention ratio into 1 plus G by R minus G is what is going as the justified. So if I want to derive at these numbers from the fundamental values and not from the market based values, I can arrive at all these kind of calculations. Right, I can very well arrive at all these kind of calculations. So either you may have to remember the formulas, or probably this kind of an approach which can help us in trying to identify what is the justified multiple that is associated with this particular security. Now, what are the various advantages and disadvantages of using the various multiples? We have seen that most of the times we use either P by E or P by book value or price to sales, price to cash flow, and nowadays we are also using dividend yield kind of approaches as ratios. So what are the positives and the negatives of each of them? Let's have a quick look at it. When I look at the price to earnings ratio, probably in the investor community, EPS is one key parameter which is targeted very heavily by all the analysts. I mean, one key parameter which everyone would like to track: earnings per share of the company. So the multiple which is very heavily linked to the earnings per share, price to the earnings per share, has become one of the buzzwords in the investment industry. So price to earnings, PE ratio, P by E ratio kind of terms are more and more a commonality in the investment industry. So from that perspective, everyone will start looking at what is the P by E for this company. Based on this, they even start making conclusions on whether it is overvalued or undervalued kind of stuff. And historically also it has been very much proven that the changes in the P by E versus stock returns, they were very heavily correlated. The changes in the P by E versus the stock returns, they were very heavily positively correlated. So that makes P by E a very good tool to go with. But of course, there is a good chance for a company to have a loss in a particular year, which means the earnings could be negative and the P by E ratio has no meaning in that particular context, especially when E is negative. there is no meaning to P by E ratio. So in those cases, for those companies where E is expected to be negative, there is no point in computing the P by E ratio. And this E keeps changing every quarter very drastically, and that too for seasonal kind of businesses and all. Each of the quarter the E could be a different number altogether. So the P by E can fluctuate quite badly, especially when the earnings are very much volatile. And as we all know, earnings are something which are prone to heavy manipulations by the management. They depend very heavily on the estimates that are provided by the management. So the P by E becomes a very distorting figure under those kind of circumstances. Though it is good to use, easy to use kind of a tool, it lacks those kind of problems from the perspectives of ethics, from the perspective of manipulations. All these things need to be thoroughly investigated before using this particular ratio. Then the alternate to that is price to book value. Generally, some positives which we see is the book value. There are more chances to be positive rather compared to the earnings, because book value is a balance sheet concept which is more and more of an accumulative piece. So as long as the company is generating profits over the last few years, the book value keeps accumulating. So book value being a cumulative figure, and it's not profit or loss of one single quarter. It's not a P&L item, it's a balance sheet item which is more of a cumulative figure. So there are high chances that it will be positive, except for some distressed firms or something like that. But in general, we see that the book value is more or less positive. So which means P by book value ratio is much more reliable compared to P by E, and even the book value is less volatile. It may not fluctuate that drastically, because as the company becomes more and more mature, book value is very significant compared to the earnings which it is generating in one single quarter or one single year. So because book value is more and more of a cumulative kind, so even a small addition or a subtraction may not impact the book value that heavily. So the changes in the book value are not that heavily volatile. That's one more thing. And because of this reason, it can even be helpful to value the firms that are in the state of liquidation also, because earnings are associated with a firm which is expected to do some kind of a business in the future but not sell off in the future. But when we are talking about the book value of equity, it need not continue the operations in future. So even for a possibly close it down kind of a firm also, we can do the price to book value approach. Means valuation can be done even for those kind of firms. And just like a P by E, historically there is existing a lot of correlation between the changes in the ratio with respect to the stock returns. And the book values and market values can change significantly because of inflation. So this is one more aspect that needs to be kept in mind before using the price to book value ratio as a multiple. Then the next, when I look at the price to sales ratio, even a distressed firm can use the price to sales ratio, because at least for a distressed firm, there is a possibility that the book value can go negative. Means a series of negative profits over the last few years, and all retained earnings are going negative and negative each of the years. Because of all this thing, there is a possibility that the book value can go negative, even though it's an accumulation kind of a piece. But sales can never go negative. In the worst case, they may touch a zero. They cannot go negative. So from that standpoint, people look at price to sales ratio being more and more stable and not that prone to manipulation compared to the earnings. So, which is good for valuing the firms which are mature or cyclical industries or even startups. Startups don't have too much of operations or too much of history of earnings and all. So, but at least sales is something which is the starting point for them. So, based on the sales forecasts and all, we can very well try finding out P by S for them, and even applicable for mature and cyclical kind of industries also. And even historically, it has been shown that the changes in the price to sales ratio are very much linked with the stock returns historically also. But the biggest drawback using this kind of ratio is, okay, here I am tracking only the sales. Okay, say as the sales is increasing, probably the price should increase. But in reality, high sales need not necessarily mean high profits. And what an investor requires is the company generating a profit and giving a dividend out of that profit. So high sales need not boil down to high profits, especially if the costs are going to be very, very high. And even from the manipulation standpoint, depending on the revenue recognition process that is being followed, there is a possibility of some kind of manipulation or tampering happening on the sale. So these aspects need to be clearly understood by the analyst. Then moving on to the price to cash flow ratio. Generally, when we talk about cash flows, there is a possibility of a reality, right? Because the cash flow is something which has to be in hand, cash that comes in hand or in the form of quick securities, marketable or equivalents of cash. So that is more of a reality kind of a concept with not too much of accounting principles surrounding it. So manipulation part is slightly more difficult with respect to the price to cash flow ratio, and even it takes care of the quality of earnings, which is how much manipulation, whatever the manipulations are happening, it takes into consideration the quality of the earnings. And even historically, there is a strong relationship that is seen with respect to the stock returns. But the biggest problem is what should be used as a cash flow. We'll see that in some cases people use cash flow from operations. In some cases people use FCFE or FCFF kind of tool, or in some cases even EBITDA is being used as a cash flow alternative, or in some cases as plain as net income plus non-cash expenses. These are being used as a cash flow. So different methods of cash flows are being used. So which one is more reliable or more suitable? Because let's say a tool like FCFE is very heavily volatile compared to cash flow from operations. So depending on which one we are using, we may end up in very highly volatile kind of a ratio. So enough care has to be taken while using the cash flow ratios as a multiple. And finally, when we are looking at dividend yield, all we are talking about is the dividend in the last 4 quarters divided by the current market price, which is a trailing dividend yield. Or when I am talking about the expected dividend in the next 4 quarters, dividing it by the market price, I am getting a leading dividend yield. Whatever it is, dividend yield is only one part of the story. If a company is not giving a dividend, it doesn't mean that it is not a growing company. It may reflect more in the capital price appreciation. So dividend actually contributes though dividend contributes to the total investment return, it is not the total investment. There is a other side of the story also. So enough care has to be taken while using the dividend yield as a multiple for comparison, because different companies have different dividend policies. So based on that, if the dividend is lesser, probably it may contribute to the capital appreciation or vice versa. So enough care needs to be taken when we are using the dividend yield kind of an approach for valuation kind of purposes. Now, the most important aspect here in the computation of these multiples, especially the P by E multiple, very interesting aspect. Yes, I take the price, I take the earnings. But this earnings, which is a net income, will be coming after revenues minus expenses minus depreciation, probably minus non-recurring items also, non-recurring or extraordinary kind of items, and minus the financing cost minus the taxes. All these things put together is what is arriving at the net income. And okay, these are all regular as a part of every year or every quarter. We see these kind of numbers as a part of the business. But the non-recurring items is something which could be in the form of a gain or a loss, but it is not a traditional item, right? So it is expected that to bring more and more consistency into the P by E ratio, we do the normalization of the earnings. We will talk about it, normalization of the earnings. So to arrive into that process, the first thing we are suggesting is compute from whatever are the actual earnings or actual EPS that we are finding from the last 1 year's P&L statement, right, or last 4 quarters P&L income statements. Whatever is from the last 4 quarters income statement, let's say whatever is the EPS that is being arrived at, we can make a modification to that EPS by removing the non-recurring components. Some of the non-recurring, probably the other income related ones. In that other income, probably gain on the sale of asset, gain on sale of investment. These will not happen quite regularly, and also they are not a part of the operations of the firm. Any kind of write downs that we are having, any loss that we have booked because of write down, and any kind of accounting estimates changing, and because of that some kind of losses that are being booked, all these things we are classifying them as non-recurring, which are included as a part of your net income, but they are non-recurring or extraordinary kind of item. So in some cases they form a part of your revenues and increase the net income, and in some cases they form a part of your expenses and they may decrease your net income, because there could be an extraordinary expense which might have gone in the income statement and decrease your net income. There could be a gain on a sale of an asset which could have gone into the income statement and it would have increased your net income. So what people suggest is, as a part of normalization process, first understand what are these underlying earnings. The regular earnings per share is what we are getting from your income statement. But when I use the word underlying earnings, we are referring to subtraction of, we are referring to the subtraction of all the non-recurring revenues. So non-recurring revenues I remove, and I add back the non-recurring expenses, because we might have arrived at the EPS, regular EPS, by adding the non-recurring revenues and subtracting the non-recurring expenses. So we are adjusting the EPS by subtracting the non-recurring revenues and adding back the non-recurring expenses. That is what is the process of the underlying earnings. The first step before we jump forward to find out the P by E ratio is to normalize the EPS, and in that normalization process, even the first step is find out the underlying earnings by adjusting the EPS with the non-recurring revenues and expenses part. Once this underlying EPS is arrived at, we can do the normalization of the EPS. For that, there are two mechanisms that are being suggested. So, wherein I take the historical EPS average. So, probably if the last 4 years, the EPS let's say is around EPS is, let's say, around 10, 12, 11 and 14, or probably another 16. Let's say in the last 5 years the EPS is something like this, then probably what we are saying is the normalized EPS going with the average EPS kind of an approach is nothing. So if I am using a historical average EPS kind of an approach, then 33 plus 14, 47 plus 16, 63 by 5, working out to 12.6 is my average EPS. Especially this is something that I should use, especially if I have to estimate the earnings per share in a business cycle. This is assuming that this is a 5-year business cycle, wherein probably somewhere, or let me take it as somewhere 18 here. So it has fallen and then started rising. So let's say if that is the kind of mechanism I am observing, so 8 more 30 plus 30, 60, 71. So 14.2 is what I should take as average EPS going by the average EPS mechanism, especially when I am looking at a business cycle kind of scenario. So take the 5 years which form a part of the recent business cycle, and whatever is the number of period, take the years which form a part of the latest business cycle and find out the normal EPS as the average of all the EPS of the recent periods. That is one method. Then in the other method, I don't go with the EPS. I find out the book value of the share in each of the years. I go with the book value per share in each of the years. So let me assume that if the company is profitable, probably the book value per share will keep growing up only. So let me say the book value per share is 50, 55, 70, 80, 80 and 9 or 100. Let's say these are the book value per shares for the 5 years. And I would also talk about the return on equity. Return on equity is nothing but earning divided by the book value per share. So let me assume that this is still 12%, right? 12%, 15%, 10%, 8% and 20%. Let's say these are some of the things that the company has generated over the past 5 years. Now what we are saying is, if at all I want to find out the normalized EPS through the BVPS, book value per share, into ROE is nothing but earnings per share. I think we can know this relationship because the ROE, the definition is nothing but net income by book value of equity. Net income, both of them, if I am trying to put per share, it's EPS divided by BVPS. So because of this, we get this kind of a relation, which means I can estimate EPS based on BVPS and ROE. So the normalized EPS will come out as, I will take the average ROE during the period, 12 plus 15, 27 plus 10, 37, 8, 45, 20, 65. 65 by 5, 13% is the average ROE during the period. Multiply by the book value per share for the recent. So based on this, I'll say that 13 is my normalized EPS. So either of the mechanism, either I can take the EPS average itself for the entire period, or I can take the ROE average for the entire period and multiply it with the book value per share of the recent period to arrive at the EPS as of the current period. So either using that particular EPS or when I am using the average EPS kind of a mechanism, it is expected that I do a normalization. The normalization is done only with the help of the underlying earnings, wherein all the non-recurring components are particularly removed as a part of the computation process. Alright. Now there is one more perspective to looking at these multiples. Probably predicting the P by E using a mechanism like regression, where you take historical P by E's as the dependent variables and probably some set of fundamental factors. Let's say the sales growth, or probably let's say the beta, or probably the required rate of return, or probably the dividend payout ratio, or anything else. What we can do is we can take this historically as the dependent variable and all these values as our independent variables, and based on this a kind of a regression can be performed. So probably if there is a forecast relating to the sales growth for the next period, the beta for the next period, and all these kind of situation, then I can look at what would be the projected P by E for this particular company for the next period. But the biggest problem is that the one that exists with all kinds of regression kind of relationships, especially when I am using multiple independent variables. In reality, these independent variables may not be independent at all. There may be some level of interdependency between these various independent variables. That is what is the scenario of multicollinearity. So because of this multicollinearity, addressing this and probably doing a factor analysis or principal component analysis, and based on that trying to come out with the predicted P by E. So such kind of a process need to be followed, because the independent variables in reality are not really independent. That is one major drawback using this mechanism. Other thing what we see is, okay, these are the P by E's historically at different points in time. These are the growths historically at different points in time. The relationship between the P by E and the sales growth may not have been similar across time. Probably initially there was a very heavy positive relationship, but towards the off late we are seeing that probably the sales growth is not that heavily linked with P by E. But when I have taken the data for this entire period, it shows some kind of a moderate relationship between the two. So because of these things, wherein the relationships actually might change over time, it may cause a kind of a problem for us to really assess the futuristic P by E based on these various fundamental factors, and to what extent the R squared come out, and that R squared itself could change with time, which means it makes in some cases for some periods probably the regression model looks more and more feasible, whereas in some periods it becomes very difficult to use a regression model. So that is where enough care has to be taken while using this regression kind of a model for predicting our P by E ratios, right? So typically though we can use these kind of regression based models to predict the multiples for the future, their limitations also need to be kept in mind. Then the next important thing that we are looking at is the aspect of the PEG ratio. PEG ratio is nothing but I have to look at P by E separately, price to earnings ratio divided by the growth. Now we have already seen that if P by E is lesser compared to the comparable firms or justified P by E, actual P by E of the firm is less than the justified P by E, we said that that stock is undervalued, right? And so if the numerator is lesser along with the growth being higher, if the growth of the firm is much high, what we see is the price to earnings to the growth ratio will be much more lesser. So if this PEG ratio is very less, it's an indication that this particular stock is more and more attractive from a stock evaluation kind of a standpoint, because in general the way people compute the benchmark, right, either we can do it from the fundamentals or we are doing it from the market itself. When I am doing in from the market, what is that we are saying? I take a list of comparable firms, I take the P by E of each of those comparable firms, perform some kind of arithmetic on that, either in terms of mean, median, some kind of descriptive statistics on that, and finally say that this is the P by E for justified P by E for this kind of a company. So I'll compare the actual P by E with the justified P by E. Anything lesser is resulting in an undervaluation. Anything higher may result in a overvaluation. But in some cases, see, if the P by E, see, sometimes even if the stock is properly valued, but if the growth rate is much lesser, okay, right now justified P by E and actual P by E are very much the same. But what can very well happen if the company doesn't have too much of growth rate, right? In the next period, the growth is not going to come up. In the future, the P by E is expected to come down. The same way, if required rate of return is very high, because the risk is very high, so we should not just restrict ourselves to comparing actual P by E with the justified P by E. Think of the growth. P by E wise, it is very much well fairly valued. But if the growth rate for the company is very less, so in the future there is a possibility that the earnings may not be that good enough, which means it will be overvalued for the future because the growth is not that great, growth rate is not that great for the company, which could result in fact in the falling of P by E in the future. The same logic could be there, especially if the risk is more with the company. The expected rate of return is much higher, and that also, because the expected rate of return is much higher, probably again in the future the P by E is going to fall down. So all these things have given rise for us to understand the other different multiple called as the PEG ratio, which is more of the P by E ratio for every 1 unit of growth. So if the growth is much higher but the P by E is lesser, see, if the P by E is less and growth is also lesser, there is nothing much with respect to the investment decision, right? Because probably it's not worthy. But if the growth is high and the P by E is lesser, that is what is an indication of attractiveness of that particular company. So that is where we are looking at both of them together rather than looking only at P by E in isolation. So we are talking about the relationship between the P by E and the growth rate. And but yeah, as I said, it is considering only the growth, but the risk is not still considered as a part of the model. So though it's a good model to use, it has a certain set of drawbacks also, because probably the relationship between the P by E and growth, it is not linear relationship. So the comparison is still, though it is a better comparison, it still has its own limitations. So these things also need to be looked at by the analyst. But yeah, rather than looking at P by E in isolation for the valuation of the firm, probably to identify a better security, looking at P by E to the growth ratio is always an advisable thing in the process of valuation. And then we see that the multiples are used even in the computation of the terminal values, especially as a part of our multi-stage dividend distribution model or multi-stage free cash flow based models. We have looked at finding out the terminal value, which is the period from where there is going to be a constant growth rate. So at this point, we were trying to find out the terminal value, but we were majorly using either the Gordon growth model there, or we said we can use the multiples based approach. So all that we have to do when I have to go with the multiples based approach is, the value here is nothing but I expect the price multiple at this point. So if I am using the P by E ratio, I will find out what is going to be the P by E at this particular point. Let's say if I am going with the trailing P by E, so at this point I will find out what is the P by E. At this point I will find out what could be the EPS, multiply these two and say this is going to be the price. But if I am going with the leading P by E, I will find out what is going to be the leading P by E at this point. I will find out the EPS that is forecasted for the next period, multiply these two to arrive at the terminal value, and both of them need to be predicted by their own prediction mechanisms. So whether I am using P by E or P by BB or anything of that sort, we have to use a mechanism to forecast the P by E at that particular point, forecast the multiple at that particular point, multiply it with the predicted factor value at that particular point to arrive at the terminal value associated with the valuation process. So we can definitely use the multiples based approach also to typically go ahead with the terminal value computation, which can be used for the regular valuation purposes. Then, as we have discussed earlier, we have been when we talk about the price to cash flow kind of multiple, we can generally use so many alternatives to cash flow. Sometimes a simple net income to the non-cash expenses like depreciation and amortization, that itself is used as a simple proxy to the cash flow. But of course, here we know that there are a lot of things like change in working capital and all those things that are not included. Sometimes if the working capital is very high, if the working capital investment is very high, the cash flow from operations show up a very lesser number, whereas the net income plus non-cash expenses show a very high number, which could have a very big impact on the multiple. Similarly, when I am taking a cash flow from operations, though it is more and more stable, but if there are majority of the capital expenses that are present for a company, if there is a lot of capital expenditure that is present, cash flow from operations does not consider that, so it may result in very high value per cash flow from operations, but the free cash flow to equity may come down quite drastically. So all these kind of things, they have their own limitations in the usage process. Similarly, when I am using EBITDA, which has nothing to do, which is purely an income statement concept and which has nothing much to do with the cash flows. Earlier also we have discussed that this is not a good proxy for free cash flows. Probably instead of using EBITDA, it's even suggested why not look at the free cash flow to the firm itself, which is a much better tool compared to EBITDA as far as the cash flows based valuation is concerned. So in the determination of P by CF multiple, which cash flow to use, there people use different kinds of cash flows, but each one has its own limitations and each one works only in certain cases. For example, there is a possibility that free cash flow to equity is more and more volatile. So that particular aspect also needs to be looked into while using the relative valuation using these various multiples. Then the next set of analysis that comes out is the concept of enterprise value, which is coming purely from a market standpoint. So when I have to define the word enterprise value, we define it as not from the, we don't use the accounting statements for enterprise value. We use the market value of debt plus market value of equity minus the cash minus the investment, even if there is a minority interest that is present. So market value of debt, market value of equity plus minority interest minus cash minus investment is what is being computed as enterprise value. And today we are seeing a much better multiple. So probably I would like to look at it as an extension to price to earnings ratio. Look at this. Price is nothing but the market price of equity, but this is the market price of equity as well as debt. So probably this ratio is an enhanced version of P by E, where this is focusing only on the equity investors, whereas this is focusing on all sets of investors. So price is basically the price per share, which is purely from an equity investor standpoint, whereas enterprise value includes the market value of debt and the market value of equity, which means it is purely focusing on the entire firm, not just the equity investors. Then again, in the denominator, we were using EPS, earnings per share, which is basically based on net income, which again is post the payment of interest which has to be paid to the debt investors. Whereas in this case, we have EBITDA, which is again the kind of a profit which the firm is generating as a whole before payment to any of the investors. So both of them more or less on the same lines, where P by E is focusing mostly on equity investor dimension, whereas enterprise value by EBITDA is focusing more on the entire firm dimension. So, especially for a firm with different capital structures, with different levels of leverage at different points in time, this ratio is much more better compared to the P by E ratio. Similarly, even if the business is a very high capital intensive business, there is a possibility that the depreciation could be much higher, and because of that there is a possibility that the net income could go negative also, but the EBITDA is still positive in that case. So even the comparison of the firms where heavy capital intensive nature is there, high levels of depreciation is associated, even there the comparisons are much more possible, because there is a possibility of the net income going negative during that period, whereas EBITDA can still be positive. But as we have been looking at, compared to EBITDA, the investment industry is more or less focused on free cash flow to the firm, a better alternative compared to EBITDA, as we have been seeing. The reason being, free cash flow to firm even talks about the reality of the cash, and it is not prone too much to the manipulations of the company, because that any cash flow related stuff is focused more and more on the reality based objective. But again, as a part of the comparison, the higher the EV by EBITDA compared to the benchmark, if this is higher, we say it is overvalued, and if it is lower, we say it is undervalued. That process is the same both for P by E as well as EV by EBITDA kind of ratios also. Now the next thing is, especially if I am looking at cross border comparisons. Let's say I want to take P by E of a US firm and compare it with a P by E of a UK firm. First of all, if the accounting methods, if the US firm is following US GAAP, whereas the UK firm is following IFRS, the way they have arrived at this E is different. So I cannot compare directly the P by E of both the firms and directly say that this is undervalued compared to this. You need to understand what are the accounting differences that have led to this particular E, which has resulted in a difference in the P by E. Similarly, as we said, not just the P by E ratio, the P by E has a different implication with respect to growth. P by E could be fairly valued, but growth and risk, these two things could result in future lowering of the P by E. So we need to really evaluate from the dimension of growth and risk also for those kind of companies. So probably looking at a PEG ratio, P by E to the growth ratio is much more appropriate from a comparison standpoint, because different countries offer different levels of growth in the industry. So because of that, the P by E could be different for each of the countries. Probably a very highly developed country, the growth may not be that phenomenal compared to an emerging market country. In that case, the P by E's could be different in a growth country versus an emerging country. I mean developed country versus an emerging country. So when I am using this kind of a PEG ratio, it is very much possible that per every 1 unit of growth I am evaluating the P by E, which can help in standardization of the calculations much more effectively. And even if we see the momentum indicators, which are typically used as a part of your technical analysis, they are going very heavily with the usage of the various ratios like this. So when we are computing the momentum indicators, we are trying to find the relationship between the price and other fundamental variables. Let's say I want to look at the EPS. I want to see over time how the EPS is changing. So that is where we use words like earnings surprise. When I say earnings surprise, we are primarily looking at by what extent is my actual EPS greater than the predicted EPS or expected EPS. By what extent the actual EPS is greater than the expected EPS. That is what we are calling as a earnings surprise. And thus sometimes I even take it as the standard deviation of the earnings surprises. So for each period we take that this is the earnings surprise, and we are dividing it by the standard deviation of the earnings surprises, which could be a definition of standardized unexpected earnings. So all these things, they play a very important role as a part of our decision process. See, if always we see that if the earnings surprise is more or less positive, which means the company is going to generate continuous abnormal returns compared to what is being expected. So sometimes people use these kind of momentum indicators to typically say whether the company's earnings are more or less performing much better to the expectations or not much better to the expectations. These kind of things based on the EPS or any other fundamental factor can very well be derived at. Yeah, another important concept in this scenario is, let's say I take a group of comparables. Okay, this is easy to demonstrate with an example. I take a group of, I take two competitors and whose P by E, let's say, is 10 for this and P by E is 12 for this. Right? I want to find out for the third company, which is my target company, I want to find out what is the justified P by E for this. We said earlier that it's better, probably I may take the mean, I take the comparables and I take the mean or median or some such kind of calculation on these and link it with the target P by E. So probably if I am taking the arithmetic mean for this, let's say it is becoming 11. Probably when I am taking the median for this also it may be 11. But let me look at it the other way. If I say the earnings for this company are $2 per share and the earnings for this company EPS is $2 per share and EPS for this is $3 per share. Now, what is happening if I want to find out the combined P by E ratio based on this group of multiples? Let's say I am trying to find out the combined P by E ratio. Now, one way is directly find out the P by E average, or probably from here if I am trying to go a little bit more, the price for this is 20, the price for this is 36, right? If I am having a portfolio of, let's say, 1 plus 1, in reality what is my combined P by E? My combined P by E should be the total price, which is 56, divided by the total earnings, which is giving me somewhere around 11.2. This should be my combined P by E ratio rather than 11, which is being given by pure arithmetic average, or 11 that is coming through the median based approach, or even sometimes people suggest take a weighted average. So 20 by 56 times the P by E 10 plus 36 by 56 times 12. Okay, what is that is going to come through this? If I am taking the weighted mean kind of an approach weighed by the price, so it is going to come out as 20 by 36 times 10 plus 20 by 56 times 10 plus 36 by 56 times 12. So this is coming out as 11.28. Even that is not a reflection of the true picture. Let's say I am taking a harmonic mean. Harmonic mean. What is that I am going to get? I'll take the reciprocals first and find the mean of the reciprocals. So average of 1 by 10 comma 1 by 12. That is the reciprocal and the mean of the reciprocals, and I take the reciprocal of that. Reciprocal of the mean of the reciprocal. So this is coming out to somewhere around 10.9. Even that is not a correct reflection. So what we are saying is the better way to arrive at is what we call as a weighted harmonic mean. The simple way we are going with the weighted harmonic mean is you take 1 divided by, take the weightages, 20 by 56 times, take the reciprocal 1 by 10 plus 36 by 56 times 1 by 12. Now try finding out what is the value for this. 20 by 560. Right, so one side it is becoming 20 by 560. That is the first part. The second part is 36 divided by 56 into 12. 36 divided by 56 into 12. So the second part is this much. Add up these two things. So adding up these two things is this much. Take the reciprocal of that. This is what we call as weighted harmonic mean, which is coming out to 11.2. In reality, it is nothing but you find out the total price. When I want the overall P by E ratio, this is one thing, especially for setting the benchmark. If at all I am having different firms with different P by E's, don't take a simple arithmetic average of those P by E's. Rather, take the prices of each one of them by multiplying the P by E with their corresponding EPS, add up all the prices, divide it by the total earnings per share, which will give me the overall P by E ratio in the netted context. That is one thing we have to be quite comfortable with while setting the benchmark. Otherwise, a simple arithmetic average or a geometric average can either give a higher value to the justified P by E or a lower value to the justified P by E. So enough care has to be taken while setting the benchmark in this aspect. So these are some of the important items that we have dealt with as a part of using the price and enterprise value based multiples for valuation of the securities. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.